Hi, everyone. This is Len Renier with Wealth and Wisdom Institute. I want to thank you for your time today. And today we're going to be discussing a very important message and some of the things that have changed in some people's lives that may impact your business. It's going to impact some people and their taxation issues when it comes to qualified plans, but it will also be important to leave the door open for additional conversations and additional opportunities. The Secure Act became active on January 1st of 2002, and there was a lot of changes that went on in the act, and we just want to bring this to your attention. And today, I brought some of my friends with me. Geri McHam is president of the Estate Planning Source, Nick Nardulli, president of the Family Defined Benefits, and myself, Len Renier, with Wealth and Wisdom Institute. A lot of times in my discussions with agents and clients, I will ask them some very important questions in my opening statement. Mr. and Mrs. Client, Mr. Planner, what do you see? More importantly, what don't you see? You see, most of life's accidents and unintended consequences are the results of things we don't see. And the barriers in your lives and in your careers are formed by only knowing what you know and seeing only what you see. So we need to spend some time in discussing with you some of the things you may not see that are lying in the future that will impact your financial future. You see, it'd be nice if we could go back to day one in your careers or in your financial life, Mr. and Mrs. Client, and start a brand new beginning. We can't do that, but we can start now and create a brand new ending. So with that, I want to discuss with you in some of our training that we have done throughout the Institute over a number of years, we have talked about the 5 core elements: the risk, the taxes, the regulation, the inflation, and depreciation of the dollar. These 5 core elements are really challenges for the average investor. We have to ask ourselves, does the 401k solve the problems of risk, taxes, regulation, inflation, and depreciation of the dollar, or did I just describe to you what it is? Now, since January 1st, there are new regulations in place. And not only are there new regulations, but it's going to impact some taxation for many of our clients and their future planning. So we talk about some of the elements that have been placed in estate plans and generational planning. And many of these situations have what I call pre-existing conditions. The stretch IRA was one of these things. It was an element where they could extend the retirement to the second generation of the family. And that seemed like a pretty good thing. But we must remember one thing. We could never escape the taxation on this. No matter what the regulation was, there was taxation either close to now or far into the future. So we have to discuss other opportunities and options that we may have. So I'd like to introduce Geri. Are you on the line?
Yes, I'm here.
Okay. I would like to, if you could, help me out here and give the audience an opportunity to know what you do in your life and explain to them what your company does.
Sure, I'd love to. The Estate Planning Source has been helping advisors and attorneys for over 30 years to provide exceptional estate planning documents for their clients. We've done over 70,000 trusts in that period of time for people all over the United States. Now, I've worked with the company for 25 years, and I've personally touched over 14,000 trusts. We have a lot of advisors, many advisors and attorneys who've been with us for longer than 25 years, so even longer than I've been around. And I consider myself lucky to have been mentored by Henry Apps, who through the years has imparted a lot of knowledge and experience and expertise to me. He wrote the Living Trust book that sold over 1 million copies. And when he passed away in 2010, died in the right year, right, tax-wise, I acquired the company from the family, and I've been the owner of the company for the last 7 years.
Well, that's
that
great.
kind of gives us an overview.
Yeah, and in your company, you provide the documents that people need when it comes to estate planning. Is that not true?
That's correct.
Okay, and we have a lot of people across the country that have used you, for a number of years and rely on your expertise to get them all the right information.
Right.
I would also like to introduce Nick Nardulli. He's the president of Family Defined Benefits. He has an estate planning background. A lot of his clientele is involved in estate planning. So, Nick, if you could do a little self presentation of yourself, if you could.
Yeah, I've been in the business. It'll be 30 years, like Geri has been in the business. And I have focused since 1990, the focus on estate planning and financial planning and retirement planning. I believe that in my practice, we accumulated over a 19-year period that I've been working with an attorney, over 1,000 clients. And, you know, as an estate planner, one of the things that I like about what we do is the dynamics of the family. I like the idea that I'm working with families that want to pass on wealth, and they want to pass it on in the most efficient way. And teaming up with people like Geri and planners around the country makes it even more fun, because we become a real creative source for solutions for our clients. And that's what keeps me up every day, because I love being solution oriented for our clients.
All right, thanks, Nick. And you've been very successful in the conversation end. Is that not correct?
It's all about the words, Len, and you taught me you are the master of that. And I tell you, in the last 4 years that I've been using the words and the communications and the tools that you armed me with, not products, but the words, I've more than doubled my practice. More than double.
I appreciate the kind words. And my name is Len Renier. I'm president of the Wealth and Wisdom Institute, and we're a communication and personal development company. What that means is it is my belief that the industry years ago walked away from training you from the inside, meaning this: you have skills and expertise inside of you, and you have the passion and everything else. The industry has stopped working on you. Instead, they've focused all of their energy on the illustrations and the product. Now, I just need to ask you, before a client buys anything, I believe they have to buy you. So we're going to have some great discussions about the Secure Act and having the right discussion that opens the door. What's important about this is that these discussions will lead to new sales for you from the same client as you open the generation gap, the generation door, as I say, for that 65-year-old client to the generation below them or above them. All assets are in play when we start talking about generational planning. So with that, I want to call back on Geri here if I could. And Geri, we talked about what do you see. Can you give us sort of like an overview of the Secure Act?
Yeah, sure. The Secure Act, and I think most of you have probably seen some of the materials on it, but I thought I'd go over a couple of the salient points on the Secure Act. It's the Secure is an acronym for Setting Every Community Up for Retirement Enhancement. And of course, with a name like that, you're going to get screwed probably. That seems to be what the government does when they pass new laws. But what's happened with the Secure Act is that they are changing most of the rules that apply to an IRA or qualified plan that is out there. A quote from Bob Keebler in a webinar that I just attended, he said, "Everything you know about IRAs has changed." Though I don't really think everything has changed, this new law is going to significantly impact everyone that has an IRA or a qualified plan. And it's going to create a great opportunity for us to help our clients with the problems that are going to result as a result of the taxation. So some of the major changes that have happened, they apply to any of the qualified plans such as IRAs, defined benefit plans, defined contribution plans, 401ks, 457s, Roth IRAs. And the new rules of the Secure Act will apply to any account that matures after January 1st of 2020 this year. They passed the law, on the 20th of December, and it was tacked on to a budget bill, so it sailed through. And although we've been hearing for the last year or so that this would pass Congress, but some of the key points of the changes that are incorporated on the positive side are those who are still accumulating wealth. It's going to be good that the required distributions won't have to start until they turn age 72. Formerly in the old law, if they passed away before December 31st of 2019, they would start taking required minimum distributions at 70 and a half. So now it changes to 72. And then a plan participant will also be able to contribute. They can keep contributing to their plan even though they've started the required beginning date, or their distribution. So you can still continue to add to your qualified plans if you want to after your required beginning date. And one of the things that does stay the same is that the distribution rules for the spouses is going to stay the same. So that they'll still be able to roll over their IRA and take the distributions over their life expectancy. So that part does not change, but it did change for the inherited IRAs, and we'll talk about that in a minute. The Acts also made it easier for employees to create an IRA account through the workplace, and they've set up automatic enrollment and the ability to have multiple accounts called MEPs in the workplace. So it's going to make savings through a qualified plan a little bit easier to get established. Now, on the negative side of things, if someone's already accumulated a lot of wealth in retirement accounts, these changes can create some really significant tax and estate planning challenges for them that we'll talk about. The most significant change, of course, that everybody's talking about is that they've eliminated the stretch IRA, and they've replaced being able for an inherited IRA to be stretched over a lifetime. They've replaced it with a new 10-year rule. So what that means is that it will now require all inherited IRAs to be distributed over a 10-year period, or by the 10th year in which the IRA owner passes away. So we don't have a life expectancy to be able to calculate on and stretch those payments out anymore. It can be made, like I said, at any time during that 10-year period. And some of the planning opportunities that we're going to have is to take a look at a person's situation and determine what's the best way to stretch out the payments for them. And we'll be looking at, the IRA owners, current circumstances, how much income they have, and also the people who are going to be inheriting those IRAs. And, are they going to be in their high earnings years? Or are they going to be at a high tax rate, et cetera? So all of that's going to play into how we're going to help our clients to minimize the tax impact of all of these changes that are going to happen or have happened. So we won't have the ability to stretch over a lifetime anymore and have that growth either. But there are some planning opportunities to set up some other plans and structures that will help a client be able to kind of recreate the whole stretchability. But the Secure Act also creates a new category of beneficiaries that they call eligible designated beneficiaries, or EDBs. They'll be able to continue to use their lifetime expectancy for payouts, and that would be the surviving spouses. As I said, they will be able to continue to stretch those over their own life expectancy. There are minor children who haven't attained the age of majority that are going to still be able to use a life expectancy until they reach the age of majority, at which time then they'll have to start taking the 10-year payout. There are disabled or chronically ill beneficiaries that are going to be able to maintain the stretch, and someone who's not more than 10 years younger than the IRA owner. So those are the exceptions to the rule of the 10-year payout. So what's going to happen? What's the impact on the current estate and wealth plans that we've already created for people? Of course, the income tax impact is going to be the biggest challenge that we face. There are a number of alternative planning techniques that are going to be vitally important to deal with the significant tax impacts that we're going to be looking at in people's estates. What we have to look at is, as we're going through this analysis with our clients, is number one, you want to look at the IRA beneficiary forms. Who do they have named? Who is it that is going to be impacted by this? What is their situation? Are they going to be at a high earnings rate when they have to take this 10-year payout? Is it going to bump them into the highest tax rate? What kind of trust do you have set up for these clients? If you have the IRA provisions in a revocable living trust, or is it in passing through an IRA trust, or do you have conduit provisions, or are the accumulation trusts? And all of those things are going to be things that you're going to be looking for as you're doing planning with your clients. So many trusts are going to require modification, because my guess, it's really a guess because I don't know for sure, is that most IRA trusts that have been set up out there, or trusts that have provisions for IRA retirement accounts in them, they are set up as conduit trusts. So anything going in is going to go out. And that creates a problem where, you're distributing out, you have liability issues, you have divorce issues, you have other issues that are going to happen in a person's life. And if you're going to make those distributions outright to somebody over a 10-year period, that's going to impact them significantly. So one of the webinars I was on yesterday, the best one I've heard so far on the Secure Act, he said every single person should have a trust to pass their retirement accounts through. There's just so many reasons to do so. So that'll be one of the things that we're going to be helping our clients with, is somehow getting those established for them and looking at all of those circumstances. So the action steps for you as a financial advisor or attorney who's working with these clients, you want to get in front of those clients. This is the greatest opportunity we've had in a long, long time, since 2001 with the Tax Reconciliation Act, to get in front of clients and review their information, their account beneficiary designations. You want to review the trust that they're in. It includes any revocable trust, any trust for minors or adult kids, special needs trust, the family marital trust, or the AB trust. Anyone who's named as a beneficiary of a qualified retirement plan or account. So you want to get in front of people and take a look at those things. You want to look at the language and figure out if it's conduit language. And if it is, you're probably going to want to update. And even some of the accumulation trusts that are out there, you will want to update because you don't have the right provisions in there that allows the flexibility, like with a trust protector or somebody who can establish and make changes to a trust without having to go to court to amend those, or have all beneficiary agreements. Different states are different the way those things come to pass, but it's just a real problem that we'll have to be addressing. You want to look at strategic conversions to go to tax-deferred retirement accounts for after-tax Roth IRAs. And there are some reasons to convert either over time or to convert some of those retirement accounts directly into a Roth IRA. Although I've heard both things. I think that the Roths are going to have to be distributed too in that 10-year period, but I've also read just the opposite. So I'm not sure at this point how the Roth IRAs are going to be treated.
Well, Geri, go ahead.
There's a lot of challenges that we're facing, and I wanted to bring Nick into this conversation about, it's very important what Geri just said. It's an opportunity to sit down and discuss their options and opportunities. Nick, you've been very successful at this over the last few years, and it's it's about the assets, it's about ownership. So, can give us an explanation of what you see and the opportunities that may be out there for your clients.
Well, it's Jerry, Jerry and Len, one of the things I like to be is proactive, you know, and I've always been a proactive planner. I've always believed that IRAs are always going to be a problem because of the regulation around them. And I look at this as more of an opportunity because I'd say for the last 10 years, I have been working with my estate planning clients that have substantial IRA accounts. And one of the things that they worry about is their kids. Because if you're doing, I always say, if you're doing beneficiary designations, explaining stretch to people, they're really trying to get these assets to their family in a real efficient manner. And one of the things, and I think Jerry can attest to this, and I think Len, you too, is that it all comes down to ownership. You know, when you own something, it's subjected to regulation and all that good stuff. Well, one of the things I look at this as an opportunity is, and I've been testing it for the last couple of weeks with existing clients, and I'm batting 1,000, and they all want to be proactive, and we're leveraging that money. We're paying some of the taxes now, getting another bucket of money out there tax-free, have it owned through a trust, like Jerry said, and then have the trust control the asset. And one of the advantages to that, no matter what the regulation is on a trust-owned asset, and Jerry, you can back me up on it, no matter what the regulation is, we don't have to worry what they do with the IRAs going down the road. So if that's someone's substantial amount of money that they're not using, okay, in retirement, one of the things that bothered me about this Secure Act of 2020, Len and Jerry, was that the government knows there's over $7 trillion of money sitting out there in retirement plans, okay? And they know this wealth is going to transfer, all right? And the beneficiaries in their 40s and 50s are what we call earning W-2 income and probably at the highest point of their lives in their career income-wise. And if they got to get that IRA out over a 10-year period of time, that's going to jump them up to a higher tax rate, and that means the government's going to get more tax revenue. I looked at that as one of the avenues of why they came up with the Secure Act was to do that. And maybe you guys can agree or disagree, but I just believe that they don't want this wealth to transfer unless it's through a trust. And that's why the marriage between us and that, Jerry and Len, is going to be the next step in the planning process for years to come.
Well, I see a lot of holes in it myself, Nick. In our discussions, we look at the shell games when it comes to regulations that the government perform on us. And I get to sit in on some of the economic ends for the actuaries of the government. And they looked at this act and saying, look, we'll go to age 72, but we have to, and their famous line is, we have to pay for this somehow. Well, in appealing to the older people saying, now we're not forcing you till you're 72 to take your money, and it allows you to accumulate more money into the future. We need to have some way to pay this. So the stretch IRA was easy pickings for them, and it doesn't impact everybody. But the government is estimating that they will get 3 to 4 times the tax revenue over the next 10 years by just making this shift from age 70 and a half to 72 and eliminating the stretch. And so now what I see as options and opportunities in this is a real opportunity to preserve the financial integrity of family. The right conversation in place might look at this and say, you know what, we have to change our look on traditional financial thinking. We're really involved in time and leverage. Where is the leverage in this qualified plan that is not impacted by risk, taxes, regulation, once again, inflation and depreciation of the dollar? Nick, you and I have had conversations about families owning the number, not dumping
Yep.
this out, but the opportunity to have the conversation is so huge right now, and doing the
Well,
right thing.
I think you're right, Len, because and Jerry, you probably can attest to this, and so can you, Len. It's all about who controls it, and
Yeah.
it's all about control. And if the family can control it, I think they could have a better number for their future than being under control of the government. That's my feeling.
Well, there's many opportunities if it's, and you might back me up on this, Nick, if it's discussed with the client in the right way. And
Yeah.
I had a conversation with somebody last night. I just said, they were talking about the stretch IRA and things like that and the changes that they're going to have to make. And I said, you know what? We're not going to escape the taxation. The taxation is going to happen either, like I said earlier, sooner or later. But it's what we do with this conversation now. You see, we can't, Mr. and Mrs. Client, we can't get to the right solution if we're having the wrong discussion. The wrong discussion is really looking at the taxation as the problem when the real solution is in leveraging what they have now in this format and making the transition.
Well, it's funny you say that. It's funny you say that, Len, because there's a representative that I work with, and he keeps on telling me, I can't fix today's problems with yesterday's solutions. That's where we're at today.
Yeah, and we recognize the problem, and like I said, the stretch IRA was a great idea, and the industry loved it too. Our companies loved it. Don't get me wrong, they loved this thing because it was all about controlling assets under management, and if they could take an asset and then stretch it out from a 65-year-old person who lived to 75 and then give it to their kids, that company's holding that asset for 30, 40, 50 years. That's our profitability center. Well, the problem
no longer. It's no longer.
Yeah. The problem is that we have there's a challenge here. Do we listen to the companies whose goal is to maintain and hold the assets for as long as they can, and the goals of the client who want to achieve their financial goals in the least amount of time? And this is a unique conversation to have, but I think once we start discussing it in different ways with representatives and the client, they'll get an understanding of what's actually going on. I like the term that you and I use, Nick, of owning the number.
Yep.
If this is a unique opportunity to step in and look at the opportunity to change the format inside what they have in this stretch IRA. Yes, you're going to have to pay the taxes or whatever. You know what? But I'm willing to leverage that tax on a yearly basis to create value inside the family of 3 to 4 times what's in that stretch IRA. And then while we're at it, let's make it tax free too.
I mean, and Jerry, don't you think, I agree with you, Len, don't you think the trust ownership is going to be more critical for the future with all the new regulations coming down?
Absolutely will. Yep.
Yeah, ownership is everything.
Ownership is everything. It is.
So
or non-ownership in some respects.
the challenge I have, guys, the challenge I look at is for many of these stretch IRA programs that were put into play, many of the representatives and many of the attorneys are no longer in practice. And we have a challenge in this industry to say we need to have the conversation with everyone. And so a lot of average Americans are going to get stuck in the situation of saying, well, I didn't know that, when it's too late. I always tell clients this. I said, the problems seem to compound faster than the solution does. And if we don't act upon this and help the clients understand what's going on, this is going to compound to them, not just only in a tax situation, but a lost opportunity cost situation in their financial future. Yeah. This is a great opportunity. We go into this conversation with a positive note to share with them. It's not all, regulation and the government, it's sort of like, that's like 5 4-letter words tied together, but it's just like we have to have the conversation, make them aware, and and let the client say yes or no to the ideas.
You know, and Len and Jerry, I think one of the things we're not talking about, which is the 500-pound gorilla in the room, is time. You know, this time that we lose by not getting this done now and not being proactive, that time lost of not planning and getting it going for our clients now can lose more opportunities for us down the road.
Yeah, and you're right. In our discussions in Las Vegas this year, we're going to be discussing time because we need to become time managers and time accumulators for our client. They want the challenges to be conquered, and they want it. They want to achieve their financial goals in the least amount of time, not the most. And so,
Yeah,
and if
and
we
they
can,
don't have a lot of time. They have 10 years.
no, you're
Come up
absolutely
with their
right.
solution.
I mean, when Bloomberg comes out and says, when he's not running for president, when he comes out and says, you know, the average 55-year-old person out there has less than $70,000 saved for retirement, he's right. But these people are out of time. We have to start looking inside that family format for different areas of revenue. Not revenue, but value. There's an important question I have with investment people. Why does the industry walk away from value that's already there? These families have value. And if we fail to ensure that value to the next generation, what type of planner are we? If we're insistent on simply looking at how we should be accumulating money, dollar on dollar, in the investments, and there's nothing wrong with that. I got investments, but the point is, what's the problem? When I mention this to people, what is the problem with having some certainty in your plan and having the family own a number?
You know, Len, it's funny you say that because you want to know something? Out of the cases that I got going this month, they're still staying with their advisor. We're just moving a percentage of the money and having the right conversation and not disrupting that, but making that relationship better and more value for the family. How can they say no to that?
Well, it's difficult to say no, but it's also difficult to discuss something that you're not aware of. And a lot of these planners, we talk about finishing the plan. When we talk about assets that are being, in play today and they're not protected from Medicare, Medicaid, long-term stays, chronic illness, we have to finish the plan. And ownership is a big conversation on this. And I'm really proud to have Geri and Nick speaking at our symposium at the end of the month in Las Vegas, and giving everybody an opportunity to question and find out more about this, because this is a great opportunity. This is one of the biggest opportunities I think the government has dealt up to us since they created the IRA. Because now,
I think so.
Yeah, we're looking at this. We now have an opportunity to have the right conversation about generational planning, the second generation up or down inside that family. Wouldn't it be amazing to have multiple premium payers in your room? Wouldn't it be amazing that you could compound the number of sales per family?
Yep.
So
it's funny you say that, Len, because people who have clients out there, and Jerry, you can attest to this, and you can too, Len, because you came from the industry. They already have the audience if they have clients. If they already have clients, they've got an audience that they need to talk to. This conversation needs to be had and learn how to address it.
Yeah, I think
how to do that at the Institute, right?
That's right.
Yeah, exactly.
I think we need to allow our clients to say yes or no to the ideas. But what a great opportunity for the professional in our business to go and have this conversation that impassions the client because it's about their family. And it gives for the first time, it gives the family to own the asset and to avoid the risk and the taxes and many of the regulations, inflation and depreciation of the dollar, things that are eating away at the buying power of their financial futures. So with that, I don't want to take up too much of time. We're going to be hitting this hard in Las Vegas. I want everybody to get involved with the movement of generational planning. It's going to be the next hybrid planning for the next 10 years in our industry. We're way ahead of the game. if you have any questions about what we're talking about today, on the screen you'll see Geri's phone number, Nick's phone number, and my phone booth number. If you have any questions about the symposium, or call these people direct. I mean, these are some of the top people that I've come across in the last 20, 30 years in the industry. They absolutely know what they're doing. Geri is a leader in the industry when it comes to helping attorneys and professionals do the right thing with their clients. Nick is just a tremendous successful track. I mean, we're talking about a guy who works independently, who does seven-figure incomes a year. And I don't mean to throw that out there like means something, because he does the right thing for his clients, but clients line up to see him. He has the right conversations, and he takes them down the right path. So with that, I want to thank everybody. We don't have time today to ask a lot of questions, but here are the people you should be calling. Get involved with the movement. Come to the symposium February 28th and 29th in Las Vegas, and meet Geri and meet Nick firsthand. You'll enjoy yourself, and you'll walk away with a defining moment in the way you look at your practice. I want to thank you for your time today, and thank you, Nick. Thank you, Geri. You guys have a great day, okay?